Chapter 5, Financial IQ 3, Budgeting Your Money. My poor dad often advised live below your means. My rich dad said if you are going to be rich, you need to expand your means. In this chapter, you will find out why living below your means is not a financially intelligent way to become rich. You will learn about budgeting, that there are two kinds of budgets. One is a financial deficit and the other is a budget surplus. The financial IQ number 3 is so important because learning how to budget for a surplus is the key to becoming rich and staying rich. A budget is a plan. One of the definitions of the word budget is a plan for the coordination of resources and expenditures. Rich Dad said a budget is a plan. He went on to say, most people use their budget as a plan to become poor or middle class rather than a plan to become rich. Most people operate their lives on a budget deficit rather than a budget surplus. Instead of working to create a budget surplus, many people work to live below their means, which often means creating a budget deficit. The first type of budget, a budget deficit. The definition of a budget deficit in Barron's Finance and Investment Handbook is excess of spending over money for a government, corporation or individual. Notice the words, excess of spending over income. Spending more than you make is the cause of a budget deficit. The reason so many people operate on a budget deficit is because it's so easy to spend money than to make money. When faced with a crippling budget deficit, most people choose to cut back on their spending. Instead of cutting back on spending, Rich Dad recommended increasing income. He thought it's smarter to expand your means by increasing income. Budget deficit of a government. When talking about the budget deficit of a government, Barron states a budget deficit accumulated by the federal government of the United States must be financed by the issuance of treasury bonds. In the previous chapters of this book, I wrote about how the US government was financing its problems by selling debt, that is, treasury bonds, that future taxpayers must pay for. The Social Security Trust Fund, which does not really exist, is filled with treasury bonds. In other words, because the US government operates a budget deficit, the money that workers and businesses have been paying into Social Security Fund has been used to pay other bills, not to increase the Social Security Trust Fund. Budget deficit of a business. Barron states corporate budget deficits must be reduced or eliminated by increasing sales and reducing expenditures, or the company will not survive in the long run. Again, notice the two choices. One choice is to increase sales and the other is to reduce expenditures. The financial statement of a corporate deficit diagram looks like the income is less and the expenditures are more, or the assets are less and liabilities are more. One of the reasons Rich Dad recommended I take a job with Xerox was that I had learned to increase sales, which increases income. For many businesses and individuals, increasing income is hard. For businesses that cannot sell, it is easier to cut expenses, increase debt, liabilities, or sell assets. The problem with cutting expenses, increasing debt, and selling assets is that it usually makes the situation worse. Again, this is why Rich Dad recommended learning to sell. If a person can learn, he or she can increase income. In Rich Dad's mind, increasing income rather than increasing expenses was a better way to solve the problem of a budget deficit. Obviously, if there are frivolous expenses such as lavish parties and non-productive debt such as a corporate jet, it may be best to address those financially irresponsible problems before trying to sell more. Budget deficit of an individual. Barron states individuals who consistently spend more than they earn will accumulate huge debts, which may ultimately force them to declare bankruptcy if the debt cannot be serviced. As we know, many people are in debt because they spend more than they earn. Yet, as stated in the previous chapter, one of the reasons people have less to spend is because financial predators are taking money from workers before they get paid. The justification for taking workers' money before they get paid is that most lack the financial intelligence to manage their own money. If our schools had financial education, maybe the workers could be trusted to manage their own money rather than let bureaucrats and bankers manage their money for them. The problem with letting bureaucrats and bankers manage your money is they think your money is their money. So bureaucrats take expenses from taxes, social security, or pension or mortgage payment. So they increase the liabilities, not the assets. People in the E quadrant often have no control over these four important expenses: taxes, social security, pensions, and mortgage payments. From this diagram, you can see how government bureaucrats take money via taxes and social security, while bankers take your money via pension, 401k, and mortgage payments. This action is the cause of budget deficit for many people. A financially intelligent person has control over these expenses. The second type of budget, a budget surplus. Barron state, a budget surplus is an excess of income over spending for a government, corporation, or individual over a particular period of time. Notice the words excess of income over spending. This does not necessarily mean living below one's means. The definition does not say a surplus is created due to a reduction of spending. Although a reduction of spending may lead to an excess of income, it does mean focusing on creating excess income. Financial IQ number 1, making more money. Rich Dad loved the words excess of money. This chapter is about excess of income rather than reducing expenses and living below your means. Budget surplus of a government. Barron state, a government with a surplus may choose to start new government programs or cut taxes. There are some issues with this statement. Problem number 1 is that when government creates a surplus, they spend the money. This is how government contracts work. If a government agency is efficient and saves money, the agency is punished instead of rewarded by having next year's budget reduced. To avoid this, most government agencies spend all their budgeted money even if they do not need to. This means costs keep going up and the chances of a government budget surplus are slim to none. In other words, government bureaucracies are designed to operate on a budget deficit, and regardless of who is in the power, taxes will go up. How Democrats manage a budget. You may recall from the previous chapter, the Democrats love to tax and spend. Democrats love to spend on more government social programs like Social Security and Medicare. The problem is social programs only grow bigger because they fail to solve the problem they have created to address. In order to counteract this, the budget is increased and the vicious cycle continues. And government mediocrity is rewarded and efficient is punished. The following: how Republicans manage a budget. The Republicans tend to borrow and spend. They want to expand the economy by flooding the money supply with funny money via debt. It's almost like flooding the economy with legal counterfeit money. Again, extra money looks like an increase in income, but in reality it is an increase in debt in the form of T-bills and bonds. Investing our money. In 1989, Kim purchased her first rental property. She put down $5,000 and made $25 in positive cash flow per month. Today, Kim controls a multi-millionaire dollar portfolio and over 1,000 rental units, and it's still growing. If we had not made investing an expense and paid ourselves first, we might still be paying everyone else last. Savings. We saved money until we had over a year's expense in cash. Instead of holding cash in a retail bank, we hold it in gold and silver. ETFs, exchange traded funds. This means that if we need cash, that is liquidity, or our liquid assets are held by our stock broker in gold and silver certificates, not in cash at a retail bank. As you know, I do not like the US dollars because it continues to drop in value. Holding cash or savings in gold and silver also hinders me from spending it. I hate cashing in gold and silver for dollars. That's trading in assets that rises in value for a commodity that depreciates. God is our partner. As far as teaching goes, we continue to donate a large percentage of to charitable organizations. It's important to give. As my very religious friends say, God does not need to receive, but humans need to give. Also, the reasons we give is because this is our way of paying our partner, God. God is the best business partner I have ever had. He asks for 10% and let me keep the other 90%. You know what happens if you stop paying your partners? They stop working with you. That is why we do it. Coming up short. When we budgeted for a surplus, the first thing came and I found out that we were not earning enough money. One of the benefits of coming up short every month was that we faced the problem of not having enough money early on. Rather than later in life. I suspect there are many people who are coming up short every month and will come short later in life when their working days are over. Then it might be too late for them to solve the problem if they don't have enough money. As I stated at the start of this book, if you don't solve a problem, you will have that problem all of your life. Problems rarely solve themselves. That is why we decided to pay ourselves first early in life, even though we came up short. Coming up short forced us to solve the problem of not having enough money. Who screams the loudest? When we pay ourselves first, the people who screamed the loudest were the banks and people who owed money to. We owed money to. Instead of letting them intimidate us into paying them, we let them intimidate us into increasing financial IQ. Number one, making more money. Many people do not pay themselves first because no one yells at them. No one hires the bill collector to collect from themselves. You do not threaten yourself with foreclosure. In other words, we do not put pressure on ourselves if we do not pay ourselves. Yet we bow to pressure from our creditors and pay them. Kim and I use the pressure tactics of our creditors from our expense column to motivate us to make more money and increase our income. Budget tip number 2. The expense column is the crystal ball. If you ever want to predict a person's failure, just look at the person's discretionary monthly expense. For example, person A, donation to church, savings, book on investing, seminar on investing, gym, dues, donation to charity, and personal coach. Person B, 6 pack of beer, new shoes, new TV, football tickets, 6 pack of beer, a bag of potato chips, 6 pack of beer. Rich Dad said you can tell a person's future by looking at what they spend their money and time on. He also said time and money are very important assets. Spend them wisely. You can tell how important a budget surplus is to someone by looking at their expense column. Just look at how much money is being paid to other organizations or people first. Notice that I put retirement as a liability. In technical terms, it is an unfunded liability until it becomes an asset. And if you are banking on your 401k for your retirement, you will be paying the highest percentage in taxes because it is taxed as income, as earned income. Compare that expense column is to pay yourself first expense column. Remember this, your asset column is your column. If you do not pay yourself first, no one else will. Through your everyday expense, you and God, if you believe in, and you give charity to God determine your financial future. Budget tip number 3: my assets pay for my liabilities. My poor dad believed in buying cheap. He thought being frugal was smart budgeting. We lived in an average house in an average neighborhood. My rich dad loved luxury. He lived in a fabulous home in an affluent neighborhood and lived an abundant lifestyle. He did not like being cheap, although he was still careful with his money. If my poor dad wanted a luxury item, he simply denied himself the luxury of owning. He said we can't afford it. If my rich dad wanted a luxury item, he simply said, how can I afford it? And the way he afforded it was to create an asset in the asset column, an asset that paid for that liability. His finan In other words, he acquired assets by paying himself first with the cash flow from the asset, and then purchased his luxury liabilities. If he wanted big luxuries, he first created big assets. What many people do is buy big luxuries first and never have enough money to purchase assets. Again, it's a matter of priorities. The Bentley account. 2 years ago, I wanted a new car, a Bentley convertible. The price was $200,000. I had the money in my asset column. I could have purchased the car for cash. The problem with buying a $200,000 Bentley with cash is that the car is worth only $125,000. The moment I drive it off the lot, and that is not a smart use of my cash. Instead of spend my cash, I called my stockbroker Tom and authorized him to convert some of my gold and silver shares into 200,000 cash. His job is to take the $200,000 and turn it into $450,000. The project was named the Bentley account. It took Tom about 8 months, but he finally called and said, you can buy your Bentley. I then wrote a check and paid for the Bentley with the cash that has been created from my assets. The reason I needed the cash traded up to $450,000 is because the extra $50,000 was to offset the taxes in the capital gain and the commission that Tom made. At the end of the day, I had my Bentley and I still had the original $200,000. If I just paid cash for the Bentley without trading the account, the ending balance sheet would look like I only have Bentley and no asset. I would have lost my $200,000 in cash asset, that is silver and gold certificates, and I would have lost an additional $75,000 due to the instant depreciation when I dropped the car off the lot. In the chapter Financial IQ number 2, Protecting Your Money, I wrote about how good brokers can make you rich and bad brokers can make excuses. The Bentley account is an example of a good broker making me rich and happy, allowing me to afford the luxuries of life. So keep looking for a good broker if you don't already have one. Assets is luxury liabilities. One of the benefits of being an author is that when I want a new liability, I first write a book like this one, and the royalties from the book pay for the liability. So for example, this book is an asset and this will pay for my future liabilities. At this point, it might be beneficial to remind you that what an asset and liability are. In my book, Rich Dad Report, I defined them as simply as this: an asset is something that puts money in your pocket, a liability is something that takes money out of your pocket. There is nothing wrong with enjoying liabilities as long as you continue to pay yourself first and purchase them through the income generated from your assets. In the example above, I used my assets to purchase my liability, and at the end of the day, I still have my asset and my Bentley. Examples of other assets buying liabilities are shown. So for example, if you buy liabilities like a permanent residence, you can have like an apartment house and as an asset to pay for that. And simply like asset is like oil production and liability can be a beach house. These are actual examples of how Kim and I use our desire for luxuries to make us richer, not poorer. As stated earlier, I do not believe in living below my means. I believe in first expanding my means and then enjoying life. A person with a low financial IQ only knows how to live below his or her mean. In other words, cut expenses if you do not give yourself the luxuries of life. Why live life? Budget tip number 4: spend to get rich. When the going gets tough, most people cut back rather than spend. This is one reason why so many people fail to acquire and maintain wealth. For example, in the world of business, when a company's sales begin to drop, one of the first things the accountant do is cut back on spending. And one of the first thing they cut back on is spending on advertising and promotion. With less advertising and promotion, sales drop and the problem gets worse. One sign of high financial intelligence is knowing when to spend and when to cut back. When Kim and I realized we were in trouble, instead of allowing our bookkeeper Betty to cut back and pay bills first, we went into full scale sales and marketing and promotion. We spent time, money, and energy increasing our income. We did not cut back on expenses. Another in the workplace, there are many owners or businesses who prey upon the weak, the people who need their job and money. There are people who use the workers' weakness to make them weaker. For example, there are many big companies that cut your pay and increase your tasks to make you work harder. If you quit, they know that someone else will take your place. That is how the game is played. And that was the way things were at Xerox. When I did well, instead of giving me a raise, they cut my territory, increased my quota, and cut my pay. It was their way of making me be more productive. At first, I got very angry. I wanted to quit, and I almost did. If not for my rich dad, I might have quit. Instead, rich dad pointed out to me that Xerox was training me in the ways of business. They were training me to do more with less. They were making me stronger. Once I saw the benefit to this way of business, I actually became a better business person. I learned to take the pressure and use it to my benefit. When Kim and I told Betty, the bookkeeper, to pay us first before we paid our taxes and bills, it was our way of making us stronger, more viable for the world of business. Instead of crying, cringing, and paying when creditors called and threatened us, we used our creditors' energy to push us out the door to make more money. When people criticize and tell lies to tear me down, I use their negativity to make me more positive and determined to win. When problem arise, I use the problems to make myself smarter and to become bigger than the problem. Take it one day at a time. Budgeting is a very important process to learn and be smart at. Take the process one day at a time. Instead of fighting about money, Kim and I used the process to discuss and learn more about money and ourselves. Positive things did not happen overnight, but they did happen. If you will sincerely work at creating a budget surplus, your life will become richer. That is what budgeting is about. Using what you have, even if you have no money, to make you better, stronger, and richer. How being a poor can make you rich. Again, the definition of a budget is a plan for coordination of resources and expenditures. You may notice it does not say a plan for the coordination of money. It's about the coordination of resources. A very important lesson from Rich Dad was that a financial problem is a resource. If you solve the problem, if you learn to take financial problems such as not enough money, a bad boss, or a mountain of debt, and use them as resources and opportunities to learn, you will slowly but surely create a budget surplus. The lesson my rich dad taught me about financial intelligence is very important, is really about being resourceful. He taught his son and me to be resourceful and turn problems into opportunities. He said, "When I was a kid, I was poor, and I am rich today because I saw being poor as an opportunity. a very important resource God gave me to use to become rich. Good debt and bad debt. There are two types of debt, good debt and bad debt. Simply said, good debt is debt that makes you richer and someone else pays off for you. Bad debt is debt that makes you poor and that you have to pay yourself. Money causes some people to do goofy things. For example, many people do something financially insane like buying a big house, put in a swimming pool, use credit cards to pay the bill, and then use the equity to on their home to pay the credit card bills. This is an example of taking a bad situation and making things worse, creating a budget deficit. Our government does the same thing. Many people in government think it takes money to solve problems, so the problems gets bigger, requiring more money, which leads to a budget deficit. As a very serious problem in the world today is excessive bad debt. Bad debt is debt from a liability. Bad debt is a drag on countries, businesses, and individuals. One way to become rich is to see bad debt as an opportunity, a resource to make you richer, not poorer. If bad debt is holding you back, then you may be your own worst enemy. When people borrow bad debt to solve problems, the problems definitely gets worse and bigger. My suggestion is to look at the problem of bad debt as an opportunity to learn and grow smarter. After one of my businesses failed, I lost nearly a million dollars. After selling off personal and company assets, I still owned about $400,000. To solve this bad debt problem, Kim and I came up with a plan to eliminate all of it. Once again, instead of cutting back, we instructed Betty, the bookkeeper, to keep us on track, and we used the problem to get richer rather than poorer. In other words, we got richer while paying off all that debt. We continued to save and invest, all while aggressively paying off all our bad debt. Uh, if you would like to know more about how Kim and I got out of bad debt, we created a CD called How We Got Out of Bad Debt and a small accompanying workbook to guide those who are in bad debt. You can order it from our website richdad.com for a nominal price plus shipping. Looking back at our mountain of bad debts, I am glad Kim and I grew smarter at budgeting through our problem solving. While I never want to be that much in debt again, I am glad we learned from and solved the problem. When Kim and I were short of money, we used that problem as a resource to make more money. Rather than live below our means or borrow more bad money to pay for bad debt, we use our problems as resources to become resourceful and as opportunities to learn and become richer. Keep this in mind. Financial IQ number 3. Budgeting your money, like financial IQ number 2, is measured in percentages. The percentage of income that reaches your asset column. If taking 30% of your income is too hard, then start with 3%. For example, if you earn $1,000, instead of allocating 300 or 30% to your asset column, then direct 3% or $30 towards your asset column. If this 3% makes life harder, that's good. A hard life is good if it makes you more resourceful. The higher percentage you direct to your asset column, the higher financial IQ number 3. Today, Kim and I direct approximately 80% of our income directly into the asset column and do our best to survive on 20%. Also, we never say we cannot afford it, and we refuse to live below our means. By continuing to keep things challenging, we become more resourceful, creating a more abundant life and a budget surplus.